because again, that average hold is nearly 9 years for a VC, right? This is a marriage, and you're not getting out of it, and like you got to do that reverse diligence. In the later stages, if you have other investors or you're bringing somebody in, it's probably a shorter hold, but still you got to be aware, right? It's everything you've worked for.
Welcome to the Private Equity Value Creation podcast, where we interview leading investors, operators, bankers, and advisors to help you answer one question: how do we increase the enterprise value of our companies? My name is Shiv and each episode I will dive deep with a guest to help you become a better value creator and capital allocator. So with that said, let's jump right in and let's get started with today's episode. My guest today is Matthew Safaii from Arrowroot Capital. And what was really interesting about this episode is that Arrowroot invests in software companies that are 10 million in ARR plus. And given that it's a place where a lot of PE firms play, I had to talk to Matthew about what separates them in this crowded marketplace. And what I really liked about what Matt had to share was that they're very founder friendly and partner with founders to help them figure out creative solutions to get alignment with management teams and help previous investors get out of sticky situations and misalignments on the cap table, and also figure out a path to grow the business to scale it going forward, where the founders feel aligned enough to stay on in a lot of cases. So I really liked his message. It was quite founder friendly, which I think is rare in the private equity world at times. And I think a lot of founders that listen to this podcast that have companies that are around that 10 million in ARR mark can learn a lot from it. So with that said, I'll leave you right to it. Enjoy the episode. All right, Matthew, welcome to the show. How's it going?
Not bad. How are you?
Good. Excited to have you on. Why don't we get started by sharing your background and what you do at Arrowroot and your mandate, and we'll go from there.
Sure. Been a software investor since early 2000s, a couple startups along the way. Been at firms like Platinum Equity and TA Associates, ICG, which turned into Actua, and then started Arrowroot Capital. We're in our 11th year now.
That's awesome. Actually, TA is a very close partner of ours, and we've worked on about 40% of their portfolio, so I'm sure we have some common friends. But the other thing that's interesting about your background is you were on the board of directors of the Aston Martin F1 team. Talk a little bit about that.
Yeah, I know, an advisor there. Got connected with them when they were changing from Racing Point to Aston Martin, and helped them out with some software contacts, helped them out with sponsorships. And it became more of a passion project, let's call it, which I'm a big enthusiast. So
same here. I'm actually going to the F1 race in Montreal in a few weeks. So
really, you're going to the Montreal race. It's a great race.
Yeah, it's like down the street, but I've never been, so super excited for that.
And this weekend is Monaco, so I'm not going there. I wish I was.
That's a bucket list item. So yeah, we could jam out about that another time. But transitioning to Arrowroot, talk a bit about the types of companies you're investing in and what you look for when you're partnering with a business. Sure.
So we invest $10 to $100 million at a time. Sweet spot's probably more in the 15 to 50 range. We look for $5 million ARR plus. Really, it's probably more like 10 million ARR. And look for all the traditional metrics everyone looks for: high retention rates, sales and marketing efficiencies working, gross margins are getting there, et cetera, et cetera. Not sticklers about profitability, which I think a lot of people are in today's environment, and potentially rightfully so. That's where shareholder value is. But if they have all the right metrics and it's working, and they just need some more gas in the tank, that's what we're here for. We certainly look for great management teams, and the more confident management teams raise their hand more for help, and we want to help them as much as possible. We do it globally. So I have 3 deals in Australia. I've done a deal in South Africa and Israel, etc.
That's awesome. And there are a ton of these companies, right, or PE firms rather, that are investing in software companies around this 10 million plus range. And so what really separates out what you're doing at Arrowroot, and how do you differentiate yourselves?
It's a good question. I think it goes to the, we'll deal with, so in the 10-year bull market, and even today, VC, growth, PE lenders, they all act like themselves. They all act like they have rules. Growth rates, profitability, size of check, ownership, size of ARR, whatever it might be. And we push that aside and say, we are experts in this space, in software, enterprise software, just in general, just broadly speaking. And we can actually structure things accordingly to make a return that's aligning with management and the past investors, if they are there. And we put those rules aside where we can act like all of the above, right? Giving liquidity out like private equity, growth capital where the company may not need capital, but if they've had more, they'd grow. VC if they are in a burn and there's a need for capital, and then even debt where we come in with more of a structured equity type feature because it's needed for aligning reasons, just from where the company is. All while being growth oriented, Shiv, and while being management friendly, which is quite different.
And you said something to me right before we started recording, and I want to touch on that. You said that SaaS companies take a lot more money and time. So expand on that concept and how you look at that as you're vetting companies and looking at who you're going to invest in.
Yeah. We've invested in bootstrap companies. We've invested in businesses that have, named the alphabet letter far down the line of rounds. And enterprise software companies, a lot of them, some, not a lot, hit it out of the park, right? And they're growing companies and they do a bootstrap or they 1 or 2 rounds and they're off to the races. But for the most part, enterprise software companies take more money, more time than people think. And that's for various reasons, especially in enterprise software. One is the VCs, which have a binary outcome mentality, right? They need to bet on a market potentially early. And sometimes they bet on it too early. And the market just doesn't come to them yet. And that takes time. So you could burn money there. 2 is you could have the wrong go-to-market motion. Maybe you're trying channel sales and it should have been direct. Maybe you're targeting the wrong profile of the customer, wrong persona at the individual end customer. Maybe you're targeting SMBs and it should have been more mid-market type businesses. There can be problems with management teams early and management teams changing over, which is a reset and time-wise. Also in enterprise software, it takes a long time to build a right product, all the various integrations and some need re-platforming, et cetera, to keep up with the Joneses around them and the various other competitors they have. And then lastly, probably not only lastly, there's probably others, but in enterprise software, there are long sales cycles. And if you misforecast that, you get the wrong forecast there and you think it's going to be 9-month sales cycles, but it's really 12 to 15, that's cash burn, right? And then the last thing I will say is that mishaps happen, right? You have 5 salespeople, you have $500,000 quotas, you're growing at most $2.5 million. 2 salespeople happen to leave because they got a job at Datadog and wherever Salesforce. You lost $1 million of quota, and then it takes time to get people butts in seats, to get them productive, and then you're starting that sales cycle again, right? That's just bound to happen, and not everybody forecasts that.
And so how are you, and this is a reality of a lot of companies, right? Either they're still trying to find product market fit or trying to figure out who their ICP is or getting their go-to-market right. And then also the technology needs to catch up. And then you need certain feature sets to stay competitive. And then you have this sales motion and sales cycle and all of this. So how do you account for all of that as you're looking at companies to see, is this a good business and worthy of deploying capital into, especially if you know that they're going to either be burning cash or it's going to take them some time to recover that cash that you're infusing into the business?
Sure. Scale does it. Just scale of ARR, because that's probably more history of the customers, renewal cycles, hopefully a better cadence in sales, and it just de-risks the forecast that you're underwriting to. Back, this is dating here, but this is probably 13, 14 years ago, you got multiple expansion when you hit 1 million of monthly recurring revenue. 14 years ago, there was all the SaaS businesses were $3, $4, $5 million. But if you happen to hit that 1 million of MRR, that's when multiple expansion happened. And multiple expansion back then was 7 to 8 times revenue, by the way. And everyone thought that was bonkers. But when you get to $12 million of ARR, if you have traditional gross margins, call it 70 to 80%. If you have a certain percentage of revenue, R&D, G&A, and then you want to be a break-even business, what's left over in sales and marketing should, if you have good sales and marketing efficiency, still should equate you to be a 20% plus grower. Not saying all those companies were doing that in terms of the burn or being break-even or profitable, but the fact is you can get it to a break-even stance if your metrics are good at that scale. And that's when you de-risk things. So scale helps out all there. We would go below 10 million of ARR to look at, but they have to be very nice businesses, have gone through renewal cycles, not have the customer concentration, have a good history of selling. But something is hitting that inflection point, and you can see it in the numbers.
Right. Yeah. And I guess you're saying that because one of the things that I've noticed is just healthy businesses seem to have similar fundamentals, right? They have great net revenue retention. Maybe they're growing at a certain rate. They have healthy EBITDA margins, gross margins, et cetera. And so the valuation of those companies is at a premium, and there's all this capital kind of chasing similar companies. So how do you drive alpha in that type of an environment where companies are at a premium valuation and there's just so much dry powder chasing after those same assets?
Yeah. I'm sure, and the cost of capital is going down, which is driving up valuations. For us, it's trying to find value where others aren't, right? And that's very simple to say, but it's company, and then that goes back to the structuring. So if it's a bootstrap business and the management team, founders, they're believers, and they'd rather take a higher valuation because they're dilution sensitive and take more structure. Yes, it might take away some of the upside for us, but it is a good deal, and we can figure that out together. On other sides of it is, there could be A through G rounds. You could have $180 million put into a company that's doing 25 million of ARR. And maybe their sales and marketing efficiency has been getting better over time, and it wasn't because of all the various reasons we said why they burned too much money. And maybe it's if you talk to everybody, the employees, it's an all-star company, right? The culture's there, everyone thinks they're winning. But if you look at the cap table, it's too little, too late for these VCs. They've been in it for 9 years. They burned a lot of money. It's doing 25, but they hit this inflection point, and it's been scarlet lettered in the market. And it's finding those companies at that right time, seeing value where people aren't, and then partnering up with management team, trying to align the past cap table around it, and getting management with us and truly being a partner there. And again, it goes to what you said. I mean, at that moment in time, either it burned all this money and it was burning money in the past, and sales marketing efficiency wasn't as good. You could see it in the net retention and the gross retention. The gross margins are getting better. Sales and marketing efficiency is getting better. And maybe they tweak things along the way to get there, or maybe the market just came to them.
Right. Yeah. And so is that where you're seeing value or maybe others aren't, is the misalignment in the cap table and finding the right moment to come into these companies?
Yeah, I think that's some of the business we do. I mean, we do a lot of other more traditional looking deals. We're going to do, if it's a good returning deal, and it doesn't have to be all the structure on it at all, right? And those, how do you find those? That's one, acting as advertised, right? Being a good partner, because CEOs are part of all other CEO groups, the YPOs of the world, they all talk to each other. Other investors know from the other boards you're on, you act as advertised, and you're about growth, and you're about helping and demonstrably helping. And get to all the various stakeholders to pull in deals. So you're seeing deals that that others aren't per se. And I don't want to say proprietary, because I think everybody's talking to everybody, and to use word proprietary is hard today. Mm-hmm. But seeing a deal at the right time and making that relationship with management. Relationships are everything.
Totally. Yeah. Everybody talks, and those CEO groups, definitely it's shared, like who's a good investor and which investors have treated you better than others. Like that information gets out so quickly. So
long-term greedy, right? You got to treat the management team great and act as advertised. 100%.
Yeah, totally. Expand on this concept of the misalignment on the cap table a little bit more, just for the audience, and even for my sake. Just What are some of the common misalignments that you come across?
Yeah. A big misalignment is on the cap table is management ownership and preference stacks. And, it's in the past as an earlier stage company, you're a believer, and God bless that. And so you don't mind this structure. But when it starts piling on top of each other, and you're doing many rounds over, if you're a founder, management team, all of a sudden you can own less than 15% of the company and have all this pref. But you have an amazing business that's growing and adding value, et cetera, et cetera. And those management teams, when you are, you can get to a place where not everybody's going to win, even though there's value at the company, because the VCs are looking for 10x or zero, and the management team obviously wants enough. And so when we go into the business, it's let's take care of this so everybody wins. We love participation from the last investors, just so they're aligned with us in our round. There's carve outs up top, so the management team gets a piece of any type of exit, or re-optioning them up so they get more of the business. And essentially, it's taking a look at the company and saying, with this money, it's going to go from X, what to Y ARR. And at Y ARR, it's going to be valued at some range, right? Be it a $200 to $300 million exit, let's just say. Well, in that $200 to $300 million exit, we want to make our return. We want to make sure management makes enough for the return. So they're excited to sell in that range. And then on top of it, you got to look at the past investors and say, do they all make enough? Right? Because everyone's got to agree to sell together and be happy about it. The misalignments it's paralyzing. Paralysis is devalue.
Mm-hmm. Do you think part of it is just that founders are raising money too early in the process, or are they giving up too much equity in the process as well?
No, I don't think it's that. I think it's because the market is what it is. If you're going to take money on it, the market will set the terms and the value. So as long as you're talking to a few people, and so that's fine. But it's just knowing who you're getting in bed with. The like traditional VCs, and this isn't they're bad people. It's just their model, right? They're playing the game. If they invest in 20, that 2 are going to be home runs, and 8 are going to be good, and 10 will be bad. You don't know what they just are betting on that onto you. And so with that mentality, they are going to just keep putting money in. And I think the CEOs just need to be cognizant of that, right? And the management teams.
Yeah, I've talked about this with a lot of investors where I think founders need to have like a high degree of self-awareness of what type of company are you building. If you think you're like the next Facebook and you start raising money like that, but it turns out you're just a standard SaaS company whose potential is like 25, maybe $100 million, you're going to raise very differently. And so knowing what you are changes that fundraising structure and which investor you're partnered with, and how much equity you try to retain in the process, and how decisions are ultimately made. So I think that maybe there's like a mismatch on that front, where founders judge their companies as one thing, and so do the investors, and so you end up getting misaligned over time.
Yes, I think that's a great point. And you do have to know what the management team's thinking and have a real heart to heart, because if you are trying to turn this into $1 billion business, and we're thinking that this is our last round, but it's not going to be, well, there's other investors for that. And
Right.
we'll gladly connect you with people we think are top shelf, right? To help that cause. And I think that's right. I think it's something like, this was maybe an old data point, but it was like less than 5% of SaaS companies sell for over $100 million. Like
less than 5%. Sorry, you cut out there. Less than 5%.
5% of SaaS companies, software companies, sell for over $100 million.
Over $100 million, right?
Over time. I mean, it could take 15 years. 20 years.
Yes.
Like it's you're talking one in 20 to 40 companies here that are backed. And so you just got to be cognizant of that. And a lot of the times in the businesses in later stage where there has been a lot of money raised, there's professional CEOs in place.
Mm-hmm. Yeah, you might have one turn PE investor comes in, and then they layer on acquisitions and other things happen, and then collectively that entity is sold for more. But a founder-led business selling for $100 million plus is far more rare.
Yeah, and the professional management teams, they understand, and their awareness, as you stated, Shiv, doesn't matter what value the company is when they come in at, that their mentality is, hey, look, if I'm making 3, 5, 10, $20 million in the next 3 years, because they're not thinking about the average VC hold today is 8.9 years. And so, that's a lot of money, and it is a lot of money. I mean, there's no way around it, right? And a lot of our businesses, I don't know, I don't want to say a percentage, but a heavy minority, maybe 30% of them, there's professional CEOs in place from the past investors, but the founders are still there doing what they're good at, which is being an evangelist in the market, or being the CTO and being head of just really developing that product and being the thought leader. Or maybe it was a very salesy CEO that's now just out there and managing the sales team and being the whale hunter.
Right.
And
right.
it's a good outcome. I mean, it's a great outcome for everybody, right?
Mm-hmm. Mm-hmm. Yeah, I think in those kinds of situations, retaining the founder is so valuable because they have all this institutional knowledge. And oftentimes you see in companies when the founder leaves, you kind of lose part of that secret sauce that made that business great in the first place.
100%. And it's good for the employees, good for culture. It's good to hear that they typically can double click in an industry quite well. And
right.
in those scenarios, the biggest ones that have worked I've seen are the ones where the founder still has a very good relationship with the new CEO and is very mature about it all.
Yeah, and I guess the value of the professional CEO there, as you're saying, is just to professionalize the business and take it to the next level of growth, right? Which maybe the founder is not in their sweet spot to do that work.
That's right. It's institutionalize it. This person has been in front of many boards, so knows how to handle the boards through the ups and downs, and then also typically is a person who has driven companies to exits, because an exit process, it's not like everyone has been through it.
Right. Not everybody's been through that and knows what it takes. So is that the main thing that you're looking for in that professional CEO, or are there other characteristics that when you're bringing in a professional CEO, you're trying to bring into these founder-led companies?
Someone that can communicate with the board, someone that is a very balanced person, because it's not always rainbows and butterflies. Somebody who has deep relationships, for partnerships and corporate development. Typically somebody who has been through fundraisers, be it debt raises, be it equity raises, depending on the situation, someone who has done add-on acquisitions and integrations in the past. But it probably is a bit of a bespoke for every situation for the company.
Mm-hmm. Yeah, and expand on this point about just the companies getting to a point where realizing that, hey, in general, founder-led companies don't exit for more than $100 million. And so how should that change behavior up front when you're thinking about your software company as a founder, as you're trying to build it out and thinking about fundraising and actually eventually exiting it at some point?
I would say it depends on the person, Shiv. I mean, the people that make $1 billion companies are the ones that set out to make $1 billion company, right? But I think they just have to know that there is a chance that failure happens, and for that nth type of result, but also be malleable and be committed to the company to a point, unless they want to bring the professional CEO themselves. That there will be some pitfalls along the way, and this might end up being a $200 million exit, or 150 or $50 million, and then that's all great if they're comfortable with that through it all. I mean, some people are hard charging and want to make $1 billion company, especially somebody who's had a couple exits below them and has the resources, etc. And that's awesome too. So it goes back to what you said. Just be aware.
This is a tricky question. Obviously, you're in this business, but just curious for your take. When should a founder not take on capital or delay that because they're in a specific stage where maybe it's not as necessary? How do you see that?
Tough question. There's so many variables there. Again, what does a founder want? You could have a $20 million business that's making 5 of EBITDA and growing 40% year over year. That's probably worth, I don't know, $150 million. And just making numbers up here, and maybe that is good enough, right? But you could take that same person and say, no way, I want to raise money because I want to do an acquisition of a same size company because I want to just keep going. For me personally, if I were to start a company, I would just want to make sure that I was raising, and it depends on the economic environment, but I had proper uses for the capital. And I was very confident in the assumptions I was making, such as if sales and marketing efficiency is so-and-so, however it might be, and I'm at 5 salespeople again, and I want to go to 10 salespeople, then I'm making the correct assumption of what's going to happen there with the sales and marketing efficiency, and not drink the Kool-Aid. If you're just taking on capital because you're burning and it's just the right thing, you raise a Series B after a Series A, and that's your mindset, I have a bit of a question mark there.
Yeah, I think a lot of companies, actually, even just a couple of years ago, you were seeing tons of companies almost get unicorn valuations, raising $100 million here, $200 million there. And there were a lot of assumptions that were incorrect in some of those valuations, and investors had to write down some of those assets, or will have to.
If they got some silly valuation or high valuation, which is probably normal at the time, and they weren't getting diluted as much, and there wasn't a lot of controls and provisions and bells and whistles, then that was probably a great move.
Right, because they're stocking up their cash reserves, and they're able to ride out this time a lot better.
Right, but you have to be aware that if it doesn't go as planned, it might not have been as dilutive. But if 4 or 5 years passes and you're still not around that valuation, that misalignment occurs with the cap table, and so you just have to be aware of that.
Right. What are just help me understand in that situation, as the market turns, right, or has turned with the interest rates and everything, but you've raised that kind of capital, you're in a really great place because you can say, hey, we know that our customers are not spending as much money or purchasing the way they were 18 to 24 months ago. So instead of over investing in sales and marketing today to hit our targets, we're going to be efficient right now until the market turns again, and then be more aggressive with this capital at some point. Isn't that like a way to get to alignment, even though maybe you're missing on sales projections?
Well, it depends on what the valuation is. It depends also what type of returns a past investor is looking for. If you get an investor and they were looking to make 2 or 3 times their money, more in the private equity mindset, that's one thing. But if you were going with an earlier stage Sand Hill Road firm that needs a 10x plus or a 0 or something that's not 10x, that's different. It's a different mentality. And then going back to what in this down market, if you have the right metrics and you're of scale, you can make some changes to become profitable and slower growing, and that actually is increasing shareholder value. Right? And just getting out of the mentality of growing at, if I'm growing at 50% and not 30%, that 50% is worth more. Well, no. If you're a break-even company comparable to making some cash flows, no, actually, in this market, it's cash flows.
So we talked about self-awareness for founders. Like, doesn't a similar concept apply to the investor, right? And I get like a PE firm, 3 to 5x, they're going to be quite happy over a 7-year period if they return that kind of, if they return the fund in that way. But on the side of investors that are making these large scale bets and expect 10x returns and have a bunch of these bets out there, isn't there like a conversation about self-awareness there too? Because you can't force a business to grow into something that it's incapable of growing into as the market changes, especially, right? Certain things are affected by macro factors, certain things are affected by the realities of consumers or existing customers or what have you. So how do you bridge that gap on the investor's side?
You're saying in terms of it's just not hitting the underwriting, not hitting the forecast, and then how do you act as an investor?
For example, you could change out the CEO, you could fire the CRO. This type of stuff happens all the time, but maybe the business is just not as a vehicle capable of going there in current market conditions, and you need to have like a reset of expectations regardless of what you expected out of that investment initially when you deployed that capital.
So as a founder, management team, you need to do the reverse diligence that I think a lot of founders don't do, especially at the earlier stage. Talk to every CEO that investor sits on the board of, not just the firm, that individual. Ask about the ups and downs. What happened when you missed 3 quarters of a row, sales forecasts? What happens, in a downturn in the market? What happens when there was a cash crunch? Not just, everyone sings when they win, right? Like that, not just when the upside. And how do they act? And I've been on many boards, and I've seen various ways some people have acted, and some people are emotional, volatile, and some people are so even keel. And you definitely want a balanced person at the board. That's one. Two is a founder CEO should ask if in a downturn, or if in a situation, try to find a situation where they weren't making the returns they were going to make, and that was pretty evident. Not only were they balanced, but did they still want to help? Did they still want to get involved? I mean, that board member is probably on 8 other boards, 7, 10 other boards, and their own personal juice is with the winners, and they want to spend all the time in the world on them. And just, you want somebody who's going to be responsive, someone who's going to be helpful, still bringing in research during downturn, and then overarching that is just someone who's balanced.
Yeah, I think that's phenomenal advice. Just the reverse diligence and understanding who are you actually adding to your management layer or investor layer in your organization, so that when the going gets tough, like when people really, that's when real personalities actually come out. Is this somebody that you are going to be able to negotiate with and have tough conversations with and navigate uncertainty with? I think that's great advice. I don't think founders do that enough.
No, especially at the earlier stage, because again, that average hold is nearly 9 years for a VC, right? This is a marriage. You're not getting out of it, and like you got to do that reverse diligence. In the later stages, if you have other investors or you bring somebody in, it's probably a shorter hold, but still you got to be aware, right? It's everything you've worked for, who you're bringing on board.
Totally. And I think the marriage analogy is very appropriate, and you're stuck together. And I think sometimes in the early days, founders are just happy to get capital because they have an idea. Yeah.
100%. And the same goes for lenders. When you're bringing on any venture debt or traditional debt, you do want to do reverse diligence there and how have they acted. And of course, hopefully it never occurs, but you got to prepare for the worst.
Yeah. And so beyond just talking to other CEOs and of that investor, what are some other things founders can do to do this reverse diligence so that they feel like they've gotten their bases covered?
Yeah. Well, talk to other CEOs that have been through it, who have raised this amount of money, and talk to them about their experience. Maybe if you're bringing on a firm, what has that firm done for other companies and the winners and losers? I do think it's more about the individual partner or investment professional on your board rather than the firm. But there is an overarching culture of various firms that you need to be cognizant of. But it is really more around the individual. But in this day of Zooms, when it wasn't Zoom, we were spending like a TA. You'd spend a lot of time with management before you did a deal. And today, it's not uncommon to go through all of diligence and management presentations and everything with Zoom, and all you did was one big in-person management presentation and maybe a dinner along the way. Again, marriage analogy. I mean, it's not an arranged marriage.
Over Zoom.
It's not an arranged marriage. Go meet the people. Go meet the people. Meet the firm. Meet the other partners. And if they're very serious about your business, they'll open the doors to that too, to win you over.
I think that's a great message and a great note to end the episode on. But with that said, Matt, thanks for coming on and sharing this wisdom. I think a lot of founders when they're thinking about how to raise capital, who to partner with, and how to plan out the vision for their business, can learn a lot from it. So I appreciate you coming on and sharing your experience.
Yeah, well, thanks for having me on.
Thanks.
All right, take care.
Thanks for listening to today's episode. Before you take off, just a few requests from our side. Number one, if you enjoyed today's content and want more of it, please subscribe to the podcast on your favorite podcatcher. Number two, if you are in the market for marketing strategy consulting services, due diligence services, or fractional CMO services, please visit our website at www.howtosas.com and schedule a consult today. And number three, if you haven't already, grab a copy of my book, Post-Acquisition Marketing. It's available on Apple Books, on Amazon, and any bookstore that you can find online. Get a copy because it walks through the framework that we take all of our clients through, and it'll definitely add value to your business. And that's it for today. We'll see you guys next time.